You know, every time a company makes a dollar, this hidden race kicks off. It's this intense competition for that cash, and we're about to figure out who really comes out on top. Let's dive into this clash between two totally different kinds of investors.
So let me ask you, who do you think gets first dibs on a company's cash? The question seems pretty simple, but the answer you'd find in a textbook, well, that's just the starting line for a much more interesting story.
Okay, so by the letter of the law, the answer is crystal clear. Debt investors. They have what's called a senior claim. Basically, if a company goes belly up, the lenders are the first ones to get paid from whatever's left. But, and this is a big but, is that the end of the story? Not even close.
To really get what's happening here, you got to know the two main players in this game. On one side, you've got your debt investors, and on the other, your equity investors.
And their goals? They are worlds apart. Think of debt investors as lenders. They're playing defense. Their whole game is about safety, just getting their money back with some interest. But equity investors? They're the owners. They're all offense, betting on big growth and hoping for rewards like dividends and a soaring stock price.
But here's the kicker. Despite their totally different playbooks, they are both fighting over the exact same prize, the company's cash. And this is where the real race begins.
So how does this race actually play out in the real world? Well, for a healthy company, what happens in practice often completely flips that textbook rule on its head.
Get this. For a healthy, growing company, cash often flows directly to shareholders before a single extra dollar is used to pay down debt. Suddenly, that whole senior claim doesn't seem quite so senior anymore, does it?
So why would a company do this? It's pretty simple, actually. Management's job is to keep the owners happy. And who are the owners? The shareholders. Paying dividends or buying back stock can boost the share price, which is a huge win for everyone on the equity side of the table.
Now, this isn't just some theory. Let's make it real and see how this all works with a company we all know, a true corporate giant, PepsiCo. To set the stage, just imagine, PepsiCo is sitting on over $30 billion in long-term debt. You'd think that paying that down would be priority number one, right?
Well, take a look at where the cash actually went. Back in 2011, more than $4.7 billion went to equity investors. By 2019, that number had jumped to nearly $8 billion. We're talking billions and billions of dollars rewarding shareholders, all while that mountain of debt was still there.
This brings us to the million-dollar, or I guess billion-dollar question. If billions in cash are flowing out to shareholders every year, how on earth is the company managing its massive debt load at the same time? And the answer might just surprise you. They didn't just service their existing debt. They actually took on more. While paying out all those billions to shareholders, PepsiCo's debt grew from about $20 billion to $36 billion. In a way, new debt was actually helping to fund the payouts to the equity investors.
So if you're a lender, this has got to look risky. Seeing a company pile on more debt just to pay its shareholders, that would seem like a huge red flag. So how do the pros get comfortable with this apparent contradiction?
I mean, this is the core puzzle for any credit analyst. You're legally supposed to be first in line, but you're watching cash that could be used to pay you back go right out the door to shareholders instead.
They get comfortable by doing some serious homework. Analysts have a structured approach. They analyze the whole industry to get the lay of the land. They dig into the business model to see exactly how it generates stable cash. They evaluate its performance and cash flows to check its financial health. And then they assess the entire capital structure to understand the real risk.
This whole process is the toolkit that helps analysts see the full picture. It lets them weigh all the risks and then summarize everything into a credit rating. And that's how they decide if lending to a company like PepsiCo still makes sense, even with this whole dynamic at play.
So, after all that, what's the big takeaway from this whole cash flow race? Okay, let's break it down. First, the law says debt is senior, but in practice, for healthy companies, equity investors often get priority. Second, those rewards to shareholders can actually be funded by taking on even more debt. And finally, the only way to really navigate this complex relationship is with deep, rigorous credit analysis.
At the end of the day, to really understand a company's story, you have to follow the money. You've got to look past the fine print and see where the cash is actually flowing. That's what tells you what's really going on.
Ultimately, a company's cash flow is its biography, written in real time. And the question it leaves us with is this. When you see how a company spends its money, whose priorities and whose story is it really telling?